You didn't need commentary to know something unusual was happening, the moment silver surged and then snapped back violently. The message was clear. This wasn't a calm rally, this was pressure releasing. The kind of move that makes confident traders hesitate and forces one unavoidable question into the room: is this the start of the next leg higher, or the moment euphoria turns into regret? What makes this phase especially dangerous is not the price itself, but the conversation around it. While most people fixate on obvious milestones, the market has already begun floating a level that feels uncomfortable, almost unreal. And whenever a market starts circulating numbers like that, something predictable follows. Emotion replaces process. FOMO replaces planning. That's when mistakes get expensive. I want to be very clear from the start. This is not about hype, and it's not about calling a top or promising a moonshot. It's about understanding where silver sits inside a much larger system. A system where money is nervous, positioning is crowded, and confidence is louder than it should be. In that environment, price can move fast in both directions. Silver is not acting alone. It's responding to fear, liquidity, and human behavior is remarkably consistent across cycles. People chase late. People panic early, and very few manage risk when things feel easy. So before we go any further, ask yourself one honest question. Are you here because you have a plan or because you're afraid of missing what everyone else is talking about? That answer will matter more than any price target discussed later. If you value calm, disciplined analysis over noise, make your presence known. Type 1 in the comments so I know you're here for structure, not hype. And subscribe now because what comes next will move faster than most people expect. To understand what silver is doing now, you have to step back from the candles and look at pressure. Price doesn't move because of opinions. It moves because pressure builds quietly and then releases suddenly. Silver had been compressing for a long time, ignored, dismissed, and underestimated. That kind of neglect is fertile ground for violent repricing once momentum finally arrives. When momentum entered, it didn't arrive politely. Volume surged, ranges expanded, and silver stopped behaving like a sleepy metal and started acting like a speculative asset. That shift matters, because when an asset changes character, the rules most people are used to no longer apply. What once moved slowly now moves aggressively. What once respected clean levels now overshoots them. This is where many participants get confused. They assume volatility means instability. In reality, volatility often means transition. It's the market figuring out who truly wants exposure and who was only comfortable when nothing was happening. Sharp pullbacks during strong trends are not random. They are tests. Tests of conviction, patience, and positioning. The chart itself doesn't care who believes in silver or who doubted it for years. It doesn't respond to narratives, opinions, or personal bias. It responds to order flow. Buyers willing to pay higher prices meet sellers willing to take profits. Where that balance resolves tells you more than any headline ever will. One of the biggest mistakes people make during moments like this is assuming the first violent move defines the entire outcome. It doesn't. Early volatility is often just the opening act. The real information comes from how price behaves after fear hits the screen. Does it collapse and fail to recover, or does it absorb selling and rebuild? That distinction is critical because it tells you whether the move is fragile or developing. And right now, silver is not behaving like something that is finished. It's behaving like something being argued over. Argued over prices rarely resolve quietly. This is also where patience becomes an edge. Most people react to speed, professionals observe structure. They let the market show its hand instead of forcing conclusions too early. And as we move forward, the levels silver interacts with will reveal whether this is just excitement or something far more consequential. When markets accelerate like this, experienced traders stop asking how high and start asking how measured, because extreme moves are rarely random. They follow expansion patterns that have shown up across decades, across assets, and across cycles. One of the most misunderstood tools in that process is the measured move framework, especially extensions that appear after a strong impulse. A lot of people dismiss these tools because they sound technical or abstract, but at their core they are simple. They map crowd behavior. They show where enthusiasm tends to peak, where hesitation appears, and where greed begins to outweigh discipline. These zones don't guarantee reversals, but they do highlight moments where decisions become harder. Silver recently surged, stalled, and then pulled back aggressively before finding buyers again. That sequence matters. A strong push followed by a sharp rejection and a fast recovery is not weakness, it's confrontation. Sellers tested the market, buyers responded, and when buyers are willing to step back in quickly after fear hits it, suggests demand hasn't been satisfied yet. This is where many traders get shaken out. They experience the drop emotionally, not analytically. They assume the move is over because it felt violent. But violence alone does not end trends. Exhaustion does. And exhaustion shows up differently. It shows up as failure to recover, inability to reclaim levels, and expanding downside momentum. What we're seeing instead is absorption. Selling pressure meets buying interest and fails to push price into sustained breakdown. That tells you the market is still negotiating higher prices, not rejecting them outright. Negotiation phases are uncomfortable. They punish impatience and reward restraint. Another critical detail is participation. As price rises, more eyes appear. New participants arrive late. Early participants begin trimming. That rotation creates turbulence, not collapse. And turbulence inside an advancing structure is often the precursor to continuation, not reversal. The mistake is assuming that clean trends look clean in real time. They don't. They feel chaotic while they're forming. Clarity only appears in hindsight. Right now, silver is writing its story in real time, and the structure is still being built. What happens next will not be decided by hope or fear. It will be decided by how price behaves when it approaches levels where emotion intensifies. And those levels are closer than most people think. Now we arrive at the level everyone is starting to feel, even if they don't want to admit it. This is where numbers stop being math and start becoming psychology. When price approaches a major measured zone, it stops behaving like a trend and starts behaving like a mirror. It reflects fear, confidence, regret, and greed back at the crowd all at once. This is the stage where volatility expands, not because something is broken, but because opinions collide. Early buyers are sitting on gains they never expected to see this quickly. Late watchers are fighting the urge to chase. And leveraged participants are suddenly very aware that the market can move against them faster than they can react. One important dynamic shows up here every cycle. As price rises, constraints tighten, margin requirements increase. Risk managers step in, weak leverage gets forced out. That forced selling creates sudden drops that feel like the end of the move. But often those drops are not signals of collapse, they are stress tests. The market is checking how much real demand exists underneath the surface. If buyers step back in after those drops, it changes the conversation. It tells you the move is not being held up by borrowed confidence alone. It's being supported by participants willing to own the asset through discomfort. That distinction matters more than any intraday candle. This is also where portfolios begin to distort. An asset that was once a small allocation quietly becomes dominant. Rational investors rebalance. They trim not because they're bearish, but because discipline requires symmetry. That selling adds friction to the trend, but it also keeps it healthier than a one-way stampede. Emotionally, this is the most dangerous zone. People who sold too early feel regret. People who didn't buy feel excluded. Both groups are vulnerable to making reactive decisions, and markets are ruthless toward reaction. The key here is not prediction. It's observation. How does price behave after sharp pullbacks? Does it reclaim ground or does it struggle? Does volatility expand upward or downward? Those answers will matter far more than any bold target. Because at this stage, silver is no longer asking whether it can move higher. It's asking who is prepared to stay rational if it does. This is where the conversation shifts from excitement to consequence. When a market approaches a widely watched objective, it stops being about discovery and starts being about behavior. Targets act like magnets, but they also act like traps. Not because the level itself is dangerous, but because of what people do when it gets close. Imagine the mindset of someone who sold early. They felt smart locking in profits. Then price keeps climbing. Comfort turns into irritation. Irritation turns into urgency. And urgency is where discipline collapses. This is how fear of missing out pulls people back into positions at the worst possible moment, right as risk is expanding. That psychological loop is why major targets matter. They don't just mark potential resistance, they expose who is trading a plan and who is trading emotion. And when emotion dominates near a key level, markets often pause or reverse, not because the story is over, but because imbalance has peaked. There are only two broad outcomes after a moment like this. The first is consolidation. Price reaches the objective, cools off, and spends time digesting gains. Volatility contracts. Impatient participants leave. Strong hands remain. This kind of pause feels boring, frustrating, and unproductive. It is also how sustainable trends reset. The second outcome is exhaustion. Price reaches the objective and fails to hold structure. Support breaks. Bounces weaken. Selling accelerates as confidence fades. This is not subtle when it happens, but it's often ignored at first because people are anchored to the recent highs. History shows that fast moves can give back a shocking amount of ground. Not because the asset is broken, but because parabolic advances rarely unwind gently. Mean reversion is brutal when it arrives late in a cycle. This is why planning matters more than prediction. You don't need to call the exact top, you need to know how you will respond if the market stops rewarding risk. Managing exposure near key levels is not pessimism, it's survival. Because the real cost of riding a move without a plan is not just lost money, it's lost time. Time is the variable most people underestimate. They focus on price gains and ignore how long capital can be trapped when a move reverses. A sharp rally followed by a deep correction doesn't just hurt portfolios, it steals opportunity. While you're waiting to get back to even, other trends are forming elsewhere. This is why experienced participants think in probabilities, not promises. They understand that trimming into strength is not an admission of fear. It's an acknowledgement of uncertainty. You don't have to exit everything. You don't have to predict the peak. You simply have to reduce exposure when risk stops being asymmetric in your favor. A common trap appears here. People tell themselves they are long-term holders, but they react emotionally to short-term volatility. That contradiction leads to paralysis. They don't sell when risk is high, and they don't buy when opportunity appears because their mindset keeps shifting with the chart. A cleaner approach is to separate purpose. Long-term holdings are governed by conviction and patience. Tactical positions are governed by structure and risk. Mixing those two creates confusion. Clarity comes from knowing why you own something before price forces the question. Another overlooked factor is re-entry. Many people fear selling because they believe they'll never get another chance. That belief is rarely true. Markets offer opportunities repeatedly, but only to those who are liquid and impatient. Selling some strength gives you flexibility. Flexibility gives you options. If price corrects and then rebuilds, a base re-entry becomes possible with less emotional stress. If price continues higher, you still benefit from remaining exposure. This is not about perfection. It's about reducing the odds of catastrophic mistakes. The market does not reward stubbornness. It rewards adaptability. Being willing to step aside when conditions change is not weakness. It's respect for risk. And risk more than reward determines who stays in the game long enough to benefit from the next cycle. While most eyes remain fixed on silver, the more important story may be what's happening around it. Capital rarely moves in isolation. It rotates hedges and seeks confirmation across related markets. That's why context matters more than any single chart. Gold plays a very different psychological role. It doesn't move with the same speed or drama, and that's exactly why institutional money respects it. When gold trends steadily while silver swings aggressively, it signals that confidence and caution are coexisting. Fear hasn't disappeared. It's just being expressed more quietly. This matters because during transitions, correlations shift. Assets that once offered diversification can suddenly move together. In those moments, the illusion of safety breaks down and liquidity becomes the true hedge. Cash, often ignored during rallies, regains importance when selling becomes urgent. Platinum adds another layer. It often lags early, then accelerates later. When multiple metals begin advancing in sequence, it suggests a broader repricing rather than a single speculative story. That doesn't guarantee continuation, but it does increase complexity. Equities contribute to their own signal. Stocks can continue rising even as internal stress builds. Late-cycle markets often feel comfortable right before conditions change. Pullbacks get bought until they don't. The transition is subtle, at first then sudden. That's why behavior matters more than headlines. Are dips being absorbed quickly, or do they struggle to recover? Is buying confident or cautious? These details reveal risk long before it becomes obvious. Silver isn't moving alone, it's part of a larger system, adjusting in real time. Ignoring that context creates blind spots. Respecting it creates balance. And balance is what keeps you positioned without becoming exposed. At this stage of a market move, the greatest danger is not volatility, it's false certainty. People want fixed targets and clear answers, but markets don't reward confidence in predictions. They reward flexibility. The traders who last are not the ones who call turning points perfectly, but the ones who adjust when conditions change. This is where structure matters more than story. Narratives can push price in the short term, but structure determines whether a move can continue. When advances remain orderly and pullbacks are controlled, demand is still present. When rebounds weaken and downside momentum expands, pressure is shifting. These signals appear long before headlines change tone. A common trap shows up here. People confuse belief with strategy. They believe in an asset, so they ignore warning signs. Or they doubt it, so they dismiss strength. Both responses are emotional. The market doesn't care what you believe. It responds to participation, liquidity, and pressure. Another mistake is waiting for clarity. Many say they'll act once things are obvious, but by the time everyone agrees, risk is already elevated. Acting with incomplete information is unavoidable. The goal is not certainty, it's alignment with price. That's why defining failure is critical. Before holding any position, you should know what would tell you the idea is no longer valid. Without that, every pullback becomes an argument instead of a decision. Right now, silver is approaching a phase where reaction matters more than conviction. The next move will reward flexibility and punish rigidity. Trends don't usually end with drama. They end when attention fades. And when attention fades, only structure remains. Now we need to talk about the moment most people mishandle what happens after a big level is reached. This is where discipline is tested, not during the run, but during the pause. When price finally tags a widely watched zone, excitement peaks, confidence swells, and risk quietly increases. This is where many participants make the same mistake. They assume arrival equals safety. They think once a target is hit, the hard part is over. In reality, that's often when the market becomes most dangerous. Late buyers rush in, leverage increases, and patience disappears. The trade becomes crowded right when upside becomes less forgiving. There are clear behavioral clues to watch here. If price reaches the level and then begins chopping sideways while holding higher lows, that's digestion. It frustrates people, drains attention, and resets momentum. That kind of pause can be constructive. But if price reaches the level and starts breaking supports, failing to bounce with strength, that's distribution. And distribution rarely announces itself loudly. This distinction matters because most damage doesn't happen at the top. It happens during denial. People explain away weakness. They anchor to recent highs. They confuse hope with analysis, and by the time clarity arrives, the market has already moved on. Another important element here is time. If price stalls for weeks or months, interest fades. The crowd gets bored and leaves. Ironically, boredom is often when the next opportunity is being built. Strong moves are usually born from quiet periods, not loud ones. This is why patience is an edge. Not passive patience, but informed patience. Watching structure form, letting the market reveal whether it's building energy or bleeding it away. Reacting only when evidence appears, not when emotions spike. If silver pauses, that does not mean the story is over. And if it breaks down, that does not mean it failed. It simply means the cycle is shifting. Your job is not to predict the shift, but to recognize it when it happens. Because markets don't reward excitement. They reward those who stay attentive when others tune out. Everything leads to this point. Not a number, but a mindset. Markets don't reward confidence alone. They reward preparation. Silver, like every fast-moving asset, will eventually force a decision, not about direction, but about discipline. The core lesson is simple. You are not paid for being right. You are paid for managing risk while you are right. Strong trends create confidence. Confidence creates overexposure. Overexposure is what turns gains into regret.